Hi, welcome back to UncoverFraud.com. My name is David Melamed, and I'm a forensic accountant and fraud investigation expert with over 20 years of experience. And today I want to talk about the question of what is fraudulent financial reporting? Fraudulent financial reporting occurs when companies or individuals purposely manipulate financial reports for their own gain. They can do this through revenue overstatement, asset inflation, volatility manipulation, or statement fabrication. These false statements could lead to outside investors to invest in a failing business that is not likely to provide a profitable return. Think about that. It's not likely to provide a profitable return. Fraudulent financial reporting is bluntly stealing. Unfortunately, it is all too common in modern business. Companies such as Theranos and most famously Enroll have all been accused of fraudulent financial reporting, and they have not only lost millions, but have tarnished the reputations as well. Companies and organization leaders intent on embezzling millions of dollars through fraudulent accounting can be deterred by forensic accountants. Typically hired by government, law, and insurance organizations, forensic accountants analyze complex financial and business matters to identify fraud. Forensic accountants must be strategic, in addition to being heavily data-centric. Let's look at fraudulent financial reporting. A common financial crime is misreporting a company's financial performance to mislead those with a financial stake in the organization. Financial criminals purposely misrepresent their company's performance to boost investments either from previous investors or potential investors. Pressure to commit financial crimes could come from business leaders or executives asking accountants to falsify reporting to mislead investors and stakeholders. While a company could experience brief benefits from financial crimes, the long-term effect of getting caught is devastating. For one thing, the public immediately loses faith in the organization. This drives away potential investors and customers, drying up the organization's income. Internally, employee morale suffers. This could lead to increased turnover rates and potentially a complete loss in staffing. Low morale could cause an organization to self-destruct rapidly. Lastly, financial fraud leads to a significant monetary loss for the organization. For every dollar taken away from the organization, funding that could have been used for hiring, talent retention, building updates, and so on diminishes. Guilty verdicts in financial crimes also force organizations to pay millions or even billions of dollars, depending on the company's size, to settle lawsuits. There are many types of fraudulent financial reporting that could occur within an organization, such as revenue overstatement. And revenue overstatement occurs when a company misrepresents its revenue in its statements by including prospective or projected sales in revenue. There's asset inflation. Asset inflation occurs when a company knowingly fails to apply a depreciation schedule to its assets. Volatility manipulation. And volatility manipulation occurs when an organization understates revenues from one period to reserve them for later periods, misrepresenting the company's year-round volatility. Statement fabrication, and statement fabrication is the most common form of fraudulent financial reporting. It is the act of falsifying areas of performance statements. Statement fabrication allows company leaders to immediately reap the rewards, as their compensation and bonuses are usually tied to company performance. World-renowned companies have been found guilty of these financial crimes, including the following. Theranos. And for those of you who watch a lot of these videos, you'll know that Theranos is a sticky subject and a sticky company for me. In 2018, the blood testing organization Theranos and its founders and chief executive officer were charged by the Securities and Exchange Commission with massive fraud. The company had raised over $700 million in funding over the previous decade based on false performance statements. The two founders were later charged by a federal grand jury with 9 counts of wire fraud and 2 counts of conspiracy to commit wire fraud. And then there's Enron. Enron was famously found guilty of massive fraud in 2011 after fooling regulators with fake holdings and accounting practices. They hid massive amounts of debt and toxic assets that are difficult or impossible to sell due to limited demand from investors through special purpose vehicles, SPVs, and special purpose entities, SPEs. The company paid its creditors more than $21.7 billion between 2004 and 2011, with its final payout in 2011. Forensic accountants play a pivotal role in identifying and stopping fraudulent financial reporting. They use their strong analytical skills to conduct vertical and comparative ratio analysis to identify red flags in a business's behavior. Forensic accountants must also be highly detail-oriented and research-driven to spot trends in data and identify outliers, things that aren't normal. Forensic accountants commonly look for the following red flags when conducting research into fraudulent financial reporting: accounting anomalies, growth in one area, revenue, without a correlating effect in another, cash flow; competitive anomalies, outlier growth in the same field in which competitors are failing; end of year or quarter growth. There's significant growth found prior to the reporting period. Aside from data skills, forensic accountants must be expert communicators to relay their findings and present their cases. Additional characteristics, including persistence, help forensic accountants seek out, detect, and support prosecution of financial criminals. Through these traits, forensic accountants can leverage their data purposefully and achieve their goal of halting fraud. Point blank, fraudulent financial reporting is done to mislead the user of the financial statements. This includes investors and potential investors, creditors, government, and financial institutions. Look, fraudulent financial reporting is not going to stop. People are going to be more creative. There's going to be more incentive. When we think about a downturn in an economy, when you start seeing outliers that have significant growth, that causes question, and it should cause questions for you. Again, my name is David Malamed, and I am a forensic accountant and fraud investigation expert. I've got over 20 years experience, and I've investigated numerous accounts of financial statement fraud, whether it's been overstating assets, overstating revenue, understating expenses, or hiding reserves to smooth out income over the year or the quarter. To find out more about me and the services we offer, please visit uncoverfraud.com. Also, if you liked the video, please don't forget to like it and to subscribe below. I look forward to seeing you again. Thanks again. God bless.